Hello and welcome. Today we're diving into a really important topic in financial planning, one that can make a huge difference to the legacy you leave behind. We're talking about managing inheritance tax. And this entire discussion, which is all about how equity release can be a really powerful tool for your tax planning, has been put together for you by the experts over at My Tax Accountant. So let's start with a big question, one that a lot of us don't really think about until it's too late. Could your home, probably your single biggest asset, actually end up creating a hefty tax bill for your family down the line? Okay, so let's get right into the heart of the matter. We're going to look at the inheritance tax squeeze and figure out why on earth so many more families are getting caught by it. Wow, just look at that number. £7.5 billion. That's what HMRC collected in inheritance tax just last year. It's a record amount. And it's not hard to see why. Property prices have been soaring, but the tax-free thresholds, they've been frozen for years. So estates that you might have thought were pretty modest are suddenly getting pulled into this tax net. So how does this all work? Well, let's break down the numbers. Everyone gets what's called a nil rate band. That's £325,000 you can pass on tax-free. On top of that, if you're leaving your main home to your kids or grandkids, you get an extra £175,000. So for a single person, that's £500,000 tax-free, and for a married couple, you can combine those, giving you a cool £1 million shielded from tax. Sounds like a lot, right? But here's the kicker. With house prices going through the roof, a lot of people are finding their estates are worth way more than that. Okay, so if you think your estate might be creeping over those limits, what can you actually do about it? Well, one of the tools in the toolbox is something called equity release. Let's get into the basics of what that means. It's actually pretty straightforward. If you're over 55 and own your home, equity release is a way to unlock some of that cash that's tied up in your property. And the money you get is tax-free. Now, it's super important to remember this is essentially a loan. It creates a debt against your home that gets paid back from your estate when you pass away or if you need to go into long-term care. Now, there are two main flavors of equity release. The one you hear about most of the time, like over 95% of the time, is a lifetime mortgage. With this, you're borrowing against your home's value, but you still own it completely. The interest it rolls up over time. The other, much less common option is a home reversion plan. This is where you actually sell a part of your home to a company in exchange for cash, and you get to live there rent-free. So just taking out equity release helps with IHT planning because it creates a debt, right, that lowers your estate's value. But where this gets really smart is when you take that cash and use it for gifting. And this is where we get into a bit of tax jargon, but stick with me. When you gift that money, it's called a potentially exempt transfer, or a PET. The key word there is potentially. Why? Because whether it's tax-free or not, all comes down to timing. And that timing is all about the famous 7-year rule. Basically, if you live for a full 7 years after you've made the gift, poof, it's completely outside your estate for tax purposes. It's like it never existed. But if you pass away inside that 7-year window, something called taper relief kicks in. As you can see here, the tax bill on that gift gradually shrinks each year until, after year 7, it disappears completely. Okay, so that's the theory. But what does it actually look like in real life? How much money are we talking about here? Let's run through a quick example to see the real-world impact. All right, have a look at this. Let's say we have a single person and their estate is worth £550,000. Now, we know their tax-free allowance is $500,000, right? So that means £50,000 is left over, and that gets taxed at 40%. Ouch. That's a $20,000 tax bill for their family. But what if they planned ahead? Look at the second line. They release and gift £100,000. Now, let's say 10 years go by, and with interest, that loan has grown to about $163,000. When it's time to calculate the estate, that debt gets subtracted first, so the estate's value drops all the way down to £387,000, which is well under the tax-free limit. The result? The inheritance tax bill is zero. Gone. Just like that. Okay, so the savings can be huge. There's no doubt about it. But, and this is a big but, this is a massive financial decision. It's not something to jump into lightly. So let's be responsible and talk about the common pitfalls, the things you really need to watch out for. I think this quote from a tax professional says it all, really. Be careful here, because I've seen clients stumble when assuming equity release is a silver bullet. It's so true. This is a powerful tool, for sure, but it is not a magic wand. You've got to think it through and get proper advice to know if it's genuinely the right move for you. And here are some of those key risks. First, deliberate deprivation. This is a big one. If you give away a load of cash and then immediately need to go into care, the local authority might challenge it. Second, you've got to think about your benefits. A big lump sum of cash sitting in your bank account could mess with any means-tested benefits you get, like pension credit. Then there's the compound interest. That loan doesn't stay the same size. It grows, and it can grow pretty fast, which means less inheritance left over. And finally, you have to remember that the goalposts can move. The government can change the rules, like they're doing in 2027 with pensions and IHT. It's a changing landscape. So with all that information, the good and the bad, what's next? What are the actual steps you can take to figure out if this is even something you should be considering? Well, let's map out a simple plan. Here's a really simple 4-step process to get you started. Step 1, just figure out what your estate is worth. Add up your home, your savings, investments, the whole shebang. Step 2, head over to the gov.uk website. They have a great little tool that'll give you a rough idea of your potential IHT bill. Step 3, play around with some online calculators. See how a loan might grow over time and what that could mean for tax savings. And step 4, and honestly, this is the most important one, talk to the professionals. You absolutely must get regulated financial and tax advice before you do anything. Because at the end of the day, this isn't just about numbers on a spreadsheet or saving a bit of tax. It's about looking after the people you love and shaping the future you want for them. And let's be honest, this stuff is complicated. It has real long-term consequences. So to make sure you get a plan that is built just for you and your family, the absolute best thing you can do is talk to the experts. Get in touch with my tax accountant and they can give you the professional guidance you really need to navigate all this.